All right, I'm Daniel Schwartzman from Investing.com, speaking today with J Mintzmyer of Value Investor's Edge over on the Seeking Alpha Marketplace. Jay, Happy New Year. How are you doing?
Happy New Year, Daniel. Doing well. Glad to be on your show and chat with you again about the shipping markets.
Yeah, so last we talked was in June of 2021. You had an amazing year, though in reviewing your year-end letter was sort of a year of two parts, and June was kind of the turning point. So just before we jump into anything more with the sector, give us a little, where are you? How did the year go? What were the sort of lessons, or what was shipping like last year?
Yeah, absolutely, Daniel. And it seems like we were just talking, a few weeks ago, but yeah, it was back in June. And I think we talked early last year as well at the start of the year. 2021 was a career year for Value Investor's Edge. And for me personally, our average model portfolios were up 136%. So that's the kind of year where, I hope to do it again, but that's the kind of year that might never happen again in my lifetime. And if that's the case where I don't do 136% again, that'll be okay. You did mention from my annual letter, you saw that it was kind of a two-part year. The first half was extreme octane. I mean, everything we were in did really, really well. In my personal accounts, we have a model portfolio on Value Investor's Edge, and that's long only, no options, no margin, nothing. No leverage, just regular stocks. And that was 136%. In my personal accounts, I do options and call spreads and things like that for more leverage. The first half of the year, we were up about 400%, which means 5X, which is insane. Again, probably never going to do that again. The second half of the year, we gave a little bit more than 10% back. So if you think, you're at 5X, you give 10% back. We still are up over 3X for the year. So it's an extreme year, but that's that was a big base to give back 10 to 11% from. So yeah, the second half of the year on a trading basis, Daniel, was a little slower for us. I do want to say though, we always talk about our model portfolios, and those actually went up 20% from the mid-year to the back of the year. And that again, no leverage, no margins, no options, just straight long stocks. And so when I talk with our members, and if you read, the annual review letter we put out, we say, hey, aggressive trading can work, but let's stick to the basics. Let's stick to the model portfolios. And again, 136% a year, Daniel. It's been a blessing to be able to put up something like that.
For sure. I mean, it's not only a blessing, obviously a testament to your skill and being in the right place, but what changed? What explains the year beyond your blessing, skill, however you want to apportion it? Like, what was happening in shipping that helped you set up the conditions for this? And then how did that change in the back half of the year?
Yeah, of course. I mean, first of all, the overall return for the year was fundamental. I mean, all the shipping stuff that we had allocated to, we allocated heavily into containers, a little bit into dry bulk, and we'll probably get into some of the segment specifics a little bit later, I'm imagining, in our conversation. But we were very heavy into container ships, the supply chain type stuff, dry bulk, iron ore, coal, stuff like that. And we avoided we only had a little bit of exposure to the tankers, which didn't do very well last year. So that's the fundamental reason is kind of the overcap of that 136% return in our models. But in terms of what happened the first half and the second half, the first half was a lot of reopening enthusiasm. Folks were buying the cruise liners, the airlines. The 10-year treasury yield was rapidly increasing in January, February, and March. And that's sort of a sign of global growth and global optimism. And transport stocks tend to be like high beta to global growth or global slowdown in reverse. So we benefited from that just massive macro tailwind. And that's why from January through about middle of June, we were just racking it up because we had the fundamentals going on for us. We also had the big macro push going. Well, mid-June, if you remember, is when Delta emerged. And that was post-stimulus, right? The whole big COVID stimulus plan in the United States had already been passed. We had shifted gears and we were talking about infrastructure bill. We were talking about Build Back Better, which, spoiler alert, as we know, did not happen. And so global growth sentiment kind of nosedived, right? We weren't sure what was going to happen with Delta. The stimulus had already happened. It didn't look like there was going to be more stimulus. So we went from macro tailwinds to massive macro headwinds in the second half of the year. The fundamentals of our companies were still solid. In fact, the fundamentals in the second half were actually better than the first half. But we were fighting a big macro headwind. So again, as we turn the corner here, Daniel, and we're recording the first week of January in 2022, I think we're at the peak of that macro headwind. I don't know if it's going to be a tailwind like it was last half. I don't want to get crazy with that, but I think it might be like a more of a neutral current, which with our fundamentals and that neutral current, we're pretty excited about 2022 here.
So when you're talking about macro, we talking the sentiment around it, or are you talking like fundamental GDP growth and everything else that goes with it, government spending, that sort of thing?
It's a combination. So it's both, the current, what's going on, what's the GDP, what's the inflation, what's consumer sentiment, what's consumer spending, but also the forward expectations. And when Delta emerged, it started slowing down in March. The peak of March was when that 10-year treasury, and you can look at a graph of that, that's when it peaked. And it started slowing down through about June. But mid-June, when Delta came out, that's when the forward expectations for global growth and consumer spending and those sort of metrics kind of nosedived. And a lot of the money in the market today, as I'm sure most of the listeners here know, is passive. And it's ETF based, quant based. And so transport stocks like shipping traditionally trade with global growth and forward global expectations. So folks think the economy is going to do really well next year. Shipping stocks tend to do well. If folks are scared of the economy, they're scared of what might happen with forward growth, shipping stocks don't do as well. That doesn't mean we can't make money selectively, Daniel. You know this. We've worked together for years, but it's a lot harder. It's a headwind as opposed to like a tailwind.
Got it. Yeah. It's interesting because both March was when the meme stock craze first peaked, I think, even obviously January, but then March was sort of, you see a lot of being on the investing site world. That was sort of a peak for a lot of the interest in investing around the world. And the Russell 2000 also seemed to peak. It took it a long time to recover to the March peak. So I think there's a lot of like correlations that happen then.
That's absolutely true, Daniel. In fact, the Russell 2000, which is kind of the main index that we use to comp our performance, because all the shipping stocks are small caps, is actually down 4% in the second half of the year. So yeah, again, huge headwind there, down 4%, whereas in the first half it was up about 20%.
Right. Yeah. Yeah. And it ended up only up 15 for the year. That's the
only 15, which is a great year, really. I mean, 15% is a great year, but it's so easy in the craze of 2020, where every stock was shooting to the moon. And even in 2021, where we had a good year, right? It's easy to think, 15%, that's terrible.
Well, that's it, right? Because 2019 also was a really good year, recovering from the 2018 sell-off. So bringing us to 2022 now, first week of the year, you talked about a neutral current. You talked about, on the one hand, we have the economic outlook, we have fundamentals, and we have market valuations, however they play. So not to boil that all down into one answer, but like, what are you thinking for 2022? How do you think things are set up for the sector and for your investing style?
Yeah, well, we'll work big to small. So broad market, I have been personally a little bit nervous about broad market valuations for quite a while. And I would have been incorrect, right? If I was picking, S&P 500 and setting targets, I have no idea where it's going to go. But I'm cautious on broad market targets. As we zoom down into the sort of macro tailwinds and headwinds in terms of global growth expectations, I feel like we're in a neutral situation in 2022. That doesn't mean the economy is going to be neutral. What I mean is the expectations we have today and what the market thinks is going to happen in 2022 seems reasonable. I think as we go through the middle of the year, the end of the year, we don't know what COVID variant is going to come out. We don't know exactly what the political responses are going to be, what the consumer responses are going to be to these shifting COVID narratives. But I feel like the current we have right now is neutral. First half of 2021 was very bullish, lots of tailwinds. Everyone was excited. Then the gears shifted mid-year and people got more cautious. So I think 2022 is a bit of a mix of those, maybe like what we saw kind of like in the middle of the year last year. And then in shipping, in terms of the actual stock specific and segment specific fundamentals, I think this is the best risk reward setup perhaps we've ever had. I think it's comparable to Q1 of 2019. Now we're taking a little bit of a time machine back here, but do you remember Q4 18? There's that big sell-off, a little bit of a taper tantrum.
Totally.
Everything just Q4 18 was nasty for people like myself who are into shipping and energy and stuff like that. Q1 19, we had just a phenomenal global economic backdrop. Everything was firing all cylinders. US economy had not been stronger in decades. The shipping stocks were trading at ridiculously low valuations. That's a similar setup, I think, on a risk reward basis that we have this year. And I think it's even better than we had last year, because last year we were in the middle of this COVID pandemic and we really had no visibility on the exit. The vaccines had barely been approved. We didn't know what was going on with those. And the balance sheets were actually not even as strong as they are today. So I don't mean to say that we're going to have more upside. I don't mean that. I don't think we're going to do 136% next year. That would shock me if we did anywhere close to that in 2022. However, I think the downsides, I think the risks are also a lot smaller because these balance sheets have been ridiculous. I mean, they've been transformed in the past year. There's virtually zero risk of any sort of insolvency, any sort of credit issues, anything like that. So maybe the upside's not as high, but there's also much less risk on a downside. So when we talk about risk reward, I think this setup is one of the best we've ever seen.
What does that look like in terms of, let's drill down a little bit more, and like, what are you seeing what are subsectors? We've talked about subsectors in the past for shipping. You've mentioned dry bulk, containers, tankers. There are 7, I think you usually name. What's standing out to you? What looks specifically for this environment? Where are the fundamentals the most sterling? Like, how are you looking at it from that perspective?
Yeah, we'll kind of group these in 3 buckets. So the most mature is sort of the cash flow harvesting segment, which is container ships. And that's been on everyone's radar due to the supply chain crisis. So in container ships, I mean, you could really drill down, like we're specialists in the sector, right? So even in container ships, there's really 3 parts. There's the liner companies, which do the shipping themselves. Think of like UPS, FedEx. The big ones there, we've been long, and I'm still long for disclosure purposes, ZIM, ZIM Integrated Shipping. There's another one called Matson, MATX. Folks have probably heard in Europe, Maersk, CMA, CGM, Hapag-Lloyd. Those are the liners. So that's one segment. We're bullish on those. There's the ship lessors, which are the ones that own the actual ships themselves. They're more of a financing play. They buy the ships and they lease them to the companies that I just mentioned. So those are companies like Danaus Corp, DAC. We're long that company, very bullish on it. And then finally, there's box lessors. These are total financing plays. They own the 40-foot boxes. So when you see a truck drive by, or you see the railroad and you see all those, those double stack boxes sometimes, there's companies that actually buy the boxes from the factories and then enter into a 5 to 10 year lease with, the Hapag-Lloyds, the Maersk, the Matsons, and they lease those boxes back to them. And so it's just a total financing play. But they've been able to roll their contracts on new terms. So one of the companies we're really excited about is Textainer Group, TGH. I'm long that one as well. So again, the shipping has so many nuances, and we've only covered one segment, Daniel, the supply chain and container ship freight markets. And I've already listed 3 different niches that we're into there. So I'm going to stop there before I keep babbling on, because that's just container ships. That's just the freight market. That's a little bit more mature in the cycle. We can talk about that a little bit, and then we'll talk about the ones that are more ongoing and maybe future recovery.
Well, I think first, I think it's a great place to stop. And before we go any deeper, what's your perspective? I think this will interest people who are not even in the shipping sector. Where are we with the supply chain? That's been the talk of, obviously, the economic world and the markets for the last 6, 9, 12 months. The backups in Long Beach, the struggle to make enough semiconductors. There's a new fire in a factory, it seems, all the time. That's another idiosyncratic cause of delay. Like, you're looking at this from these container ships and all those different subsectors, but what's your perspective as also a global economist yourself in some sense?
Right. And the freight markets traditionally, if we're looking, because I've been in shipping for about 12 years now, the freight markets have normally, sort of handled themselves. So when most folks are asking me supply chains, they're asking me about coal markets or oil flows or gasoline trading patterns. It's only been in the last, 18 months that we've been talking about LA and Long Beach, because those were sort of like, they took care of their own problems before. Look, we're in an absolute mess there. There's been a lot of political, pressure to resolve the situation quickly. So there's been a lot of talk about how their supply chain's recovering and how it's doing a lot better. The reality is the LA Long Beach queuing of ships is the worst and longest it's ever been. which is crazy to think about. I mean, all the effort, all the focus, all the stuff that's going on there, and the ship queue is longer than ever. They changed the way they count the ships. They used to just count them when they're inside the harbor. And then they made a new rule, a new law, where the ships had to stay 150 miles off the coast. And this was for, environmental reasons, safety reasons, that sort of thing. Well, then they said, well, look, all these ships, they're dropping. There's less ships in the port. You can't see them anymore, but they're still out there. They're just 150 miles away. So if you include those ships, we're at the worst it's ever been. There's still a chassis shortage. There's still issues with truck driver shortages. Now it depends on who you ask. Some people will say, well, there's not really a truck driver shortage. It's more of like a shortage of registered trucks, or it's because of the COVID isolation symptoms. But whatever the case, there doesn't seem to be enough trucks. There's not enough drivers. There's not enough warehouse space. There's not enough ships to transport the cargo. The docks are full of empty containers that are clogging everything up. I mean, there's about 12 or 13 different bottlenecks in the system. I think we're making some progress overall. I think we're past the worst of it on a global basis. But on an LA Long Beach basis, I mean, the worst of it is right now, ongoing. I think freight rates in 2022 could rival 21. In fact, they might even be higher. But I think this thing gets eventually resolved. I think 2022 is kind of the peak. I would say, sorry for the long answer, but it's just, there's no quick, pithy, response to this. There's so many moving parts going on. But I think mid to late 2022 is probably when we turn the corner and things start getting better.
This is a great response. No apology needed, but what is the proximate cause, or like, what is it? You're sort of you're making it sound, at least, like the political pressure and so on is kind of shuffling chairs a little bit and not really unlocking the problem, at least in the LA Long Beach perspective. But is it as simple as we shut down things and then it just takes a while to get back together, and then we still have these outages because a city in China shuts down because of their issues with COVID and people are getting sick? Or like, what is still keeping us from figuring this out in a way that you said we used to sort out itself?
Yeah, there's the current situation. It has definitely been inspired by the COVID disruptions. There's no denying that. But there's two underlying trends that have contributed to this process, and they've been kind of insidious trends over the last decade. So the first trend is a significant underinvestment in port technology and port development in the United States over the last decade. There's been a lot of good investment done on the East Coast. Ports like Savannah in Georgia have done a lot better. And in fact, they're doing a lot better now handling the cargo. And that's not a coincidence. That's not by accident. They've done a lot more investments. The West Coast port investments have stagnated. They got a lot of funds out of the 2008, 2009 kind of stimulus, American Recovery and Reinvestment Act, but that was 12 years ago now. And the global trade has almost tripled, container trade, since then. And the ports have not upgraded themselves. So as each year went on, the ports were operating at higher and higher percentages of capacity. And LA and Long Beach, really, if you look at 2018 and 2019, maybe it wasn't percentage of their stated capacity, but practical capacity, those ports were operating at like 95, 96, 97%. And that's J Mintzmyer's estimate of where they were operating. I'm sure the nameplate might have been different, but they were doing everything they could and operating at max capacity. I mean, they were bursting at the seams even in 2019. So underinvestment. There's been a lot of union reluctance to invest in automation technology, because as you can imagine, when you invest in automation technology, there's a lot of jobs that become redundant. And so I don't want to get into politics of who's right or what to go with, but it just makes sense, right? You have a very powerful trade union on the West Coast and doing what a union does, looking out for the interests of the workers. And they fought against automation for decades. They're still fighting against it even today. Underinvestment, not picking up the automation technologies. So that's one insidious trend that was going on for a decade. The other insidious trend is a shift towards what we call just-in-time inventory management. And if you look at 20 or 30 year chart of inventory to sales, retail inventory to sales, you'll see it's a long-term trend downward, rapidly downward, with the advent of the internet, with more advanced things like barcodes. And I mean, barcodes have been out for 40 years now, but things like that enabled better inventory tracking, which meant you didn't have to have as much in the back of the store. You didn't have to have an entire, go to Walmart. You didn't have to have an entire duplicate of the store behind full of inventory, right? You just had distribution channels. And, with e-commerce and the rise of things like Amazon, they even had computer algorithms that would predict when things would be out of stock and would automatically reorder. And so computers would predict, oh, we need more of, this toy, or we need more of this couch, or we need more shoes. And it would send a signal over to China to, manufacture more shoes. And they put them just in time, right? You get the idea. And that's been a trend for 20, 30 years. Well, just in time is great when everything is taking care of itself, when there's no disruptions, there's no delays, there's no bottlenecks. Well, the first time you introduce a bottleneck, just in time starts to fall apart. So two insidious trends that have made this situation much, much worse. Then with COVID, I think most folks understand kind of what happened with COVID. Everything turned off for a couple months, and then everything turned back on. And you have the underinvestment in ports, the lack of automation, the over-reliance on just in time, and you end up with basically a crisis.
I wonder also just sort of the abundant spending that's happening, but I wonder also such a big thing in shipping, the two what many outsiders would call insidious trends in shipping that I wanted to bring up before we get back into the other things are, one is relevant, is overbuilding, right? And I'm wondering if you're seeing any changes. It seems like there seems to be a parallel with oil, by the way, too, where shale oil producers have sort of learned their lesson and are not overproducing now that the price of oil is back up. I wonder if with the shipbuilders, or not the shipbuilders, but with are there more ships being built? Because there was a lean period where there weren't a lot of ships, which is what kind of made this a nice setup for these companies. What's going on with that amidst all these other challenges?
Yeah, so the ships were in a similar situation as the ports, but their underinvestment didn't start until I would say 2016, 2017 or so. In fact, the ships were way overbuilt around the 2008, 9, 10, 11. They were way overbuilt. So that's why I mentioned ports, because that was actually a clear trend for like 11 or 12 years. The ports were underinvested. Yeah, you're right. The ships were underinvested in the last couple of years, which meant the order book coming into even before COVID was almost non-existent for container ships. Everyone was kind of burnt, if you will, from lack of returns from the industry for the last decade. The industry went through a massive downturn from 2012 all the way through about 2018. So 6 or 7 years straight, container liners were breaking even or burning money, losing money even year after year after year. Lots of bankruptcies. Really similar parallel to what happened with airlines. Airlines from the 1980s through the early to mid 2000s. Every time you turned on the news, there was one going bankrupt. Right. And then there's a lot of consolidation in the sector. There's a lot of rationalization of the stocks. More of them became publicly listed, controlled, and that sort of thing. The same thing's happening with container liners, container shipping companies. And so you had that period where there was all these bankruptcies and all these consolidations. Well, once they consolidate, they're going to build less ships because they're going to be more rational. Right. And then again, we have what we just talked about, where everything turned off, everything turned back on. So you already had a tight capacity of ships. Now you need 10 or 20% more ships, but they don't exist. You can't build them for 3 years. In terms of, are they building more now? Yes, absolutely they are. If you've seen the rates on the ships that they're getting today, there's a huge economic incentive, as there is in any commodity industry, to build more. Right. The lack of demand is what fixes supply, and the over demand is what inspires more supply. Things balance out. It's just, economics there. Most of these ships don't hit the water until mid to late 2023. So that's why we're very excited and very bullish about 2022. And I would say even the first parts of 23, because that tonnage doesn't hit the water yet. In 23 to 24, Daniel, we're a little bit more, I wouldn't say scared, but we're definitely more cautious. And I definitely don't want to see more container ships being ordered. Every time I see a headline about, companies considering ordering more ships, I get a little bit nervous. That's why we're sticking with companies that have long-term contracts that spread out throughout those years. We don't want to pick a company that has 100% exposure to those rates in say, 6 months or a year. We want a company that is being proactive today and locking their fleet on long-term, 3, 4, 5 year contracts.
Got it. Which sort of, this is going to be bigger than container ships. It goes to the whole sector. But the other question that, we probably talk about it every time, but I think it's always worth, because I think it's the most common complaint people will usher about the sector as a whole, is governance. What's your sense on the either examples, or you talked about balance sheets rebuilding. You talked about how now in this specific sector, people are starting to order ships again. But I saw you tweeted out today, or recording this on Tuesday, you tweeted out LPG, I think, announced a dividend. Like, what's your take in general? Are you still seeing improving governance across the board? Are you seeing at least some standout players? Like, how, given such a, on the one hand, strained environment, on the other hand, boon for so many parts of shipping, like how have management teams handled it in your estimation?
Yeah, the bad governance in shipping was an accurate description, I would say, 10 years ago. Today, there's a lot more good actors and great corporate governance and strong management teams than there are bad ones, at least in terms of what we cover. We cover almost 50 firms. We cover about, I think it's 47 currently firms in the shipping industry. We don't cover any of the firms that have, I would say, like terrible governance or huge red flags, things like that. We do cover a few that are marginal, and we caveat those accordingly. But there's probably about 7 or 8 of those that we caveat with some risks. And then there's 20 that are sort of maybe mediocre, decent governance. And there's about 20 firms that we cover that have solid corporate governance. I mean, not only for shipping, but for any company. I mean, solid dividend payout policies, shareholder alignment practices, audit committees, all those sort of things that you would expect, of any S&P 500 component, right? And of course, these are smaller firms. They're not in the S&P 500, but I'm saying they have the governance suitable to be at that caliber, about half of the firms that we cover. In terms of shareholder returns, the first thing you have to do is get your financial house in order. So a lot of 2021, at least the first half, was spent, deleveraging, paying back a lot of the debt, building up a cash buffer, making sure those things were in order. I mentioned 3 companies. I mentioned Zim, which is the liner company. They IPO'd last January at $15 a share. And we were very bullish when they IPO'd. But they traded, the first day of trading was peak GameStop crisis mode. Remember, like GameStop was like ripping, and there was like this conspiracy theory or viewpoint, and maybe it was valid. I don't really know if it was valid or not, that GameStop could somehow trigger some sort of like mass hedge fund ripple effect and like crash the market. Remember that? I don't know how credible that really was, but there was like fears of like, margin calls on margin calls and shorts, and GameStop was going to go to $1 million and everyone else was going to go bankrupt. And so anyways, that was the first day of Zim's trading. So like nobody was buying an IPO on that day. It was it was like, I want to say it was like January 27th. I can't remember the exact date, but it was somewhere around there. And Zim opened out of the gate at $11 a share. And so we were buying all day that day and all day the next day, 11 through 14. We opened up position. Zim has already paid out. As of today, they've already paid out $4.50 in dividends. So it IPO'd at 15, we were buying at 11. They've already paid out $4.50 in cash dividends in less than a year, Daniel. And they're going to pay out an annual dividend of 30 to 50% of their earnings. And so based on our models, based on our projections, we believe at that 30 to 50% range, they're going to pay out $10 to $14 per share, probably around March of 2022. And so this is a company that IPO'd in January, the late January of 21. Within 14 months, so barely over a year, they're going to pay out somewhere between $14 and $18 in dividends, and they IPO'd at 15 and opened at 11. So I mean, like I just do that because I'm trying to illustrate that, like, look, these companies are doing the right thing. They are paying big dividends. They are being aligned with shareholders. That's Zim. That's one company. The other company is Danaos Corp. They went through a decade of downturn. They had to spend most of 2021 balancing, fixing the balance sheet, making sure things were stabilized, making sure they never have to go through a downturn again. They've already announced a large dividend last year. It's 50 cents a quarter. So they've paid out almost $2 so far. And they've done a lot of other good things with the balance sheet. So I'm happy with the Danaos Corp. And the third one is Textainer Group, TGH. They announced a dividend for the first time in several years. They had to cut their dividend during the last downturn. They've had share repurchases ongoing throughout the entirety of 2021, and they've refinanced their balance sheet. So 3 companies, all 3 of them, all doing the right thing. And so I just want to address that because, the shipping gets this terrible rap, right? They're not aligned with shareholders. They have this poor governance. That's true for some companies, but there's also those companies like the 3 I mentioned that are doing the right thing.
Well, and I don't know TGH's chart off the top of my head, but I know that Danaos had its run from at least September of 2020 through a lot of last year. And then Zim, you've just talked about it. It's in the 50s or 60s right now?
It's just shy of, I want to say it's about 56 as we're talking right now, 56, 57. And that IPO'd at 15. So yeah, that's basically a four-bagger, including the dividends. The Now's Corp went from $5 in September 2020. It's in the 70s today. So 14, 15 bagger there. So yeah, I mean, monstrous returns. So, those things do happen when all the stars align. Good markets, good management team, good returns, the stars align.
Right. It's just nice to see when a company's doing the right things and the stock is, correlation, causation, whatever. Usually they go together quite nicely. And so
eventually,
weighing machine. It's a weighing machine.
Sometimes it takes a little time, but eventually the markets go with the fundamentals.
Totally. So get what else? We don't have to go through every subsector, but what else is standing out to you in shipping as we enter, for the year ahead and beyond? Like, what are you excited about, or where are you spending your time?
Yeah, sure. No, we spent the most time with containerships and supply chain, I think, as we should. That's what folks are looking at. And that's kind of the mature segment. I'd say that, using baseball analogies, I'd say we're probably sixth or seventh inning, somewhere in there. Another industry we're really interested in is dry bulk. That's iron ore, coal, bauxite, grains, forestry products, things like that. That's a very spot-oriented market. And when I say spot-oriented, what I mean is there's not long-term contracts. This is like, you're going to hit it out of the park one day and you're going to lose money the next day. It's a very volatile segment, but we are bullish into 2022 and then parts of 23 because there's really no supply growth. The order book is the lowest it's been on record. There's huge environmental regulations that are going to hit the fleet in early 2023. And we think that, and when I say we, I mean our research team at Value Investors Edge, we think the China pessimism is kind of already priced in. Right? Are we concerned about China? Absolutely. Right? We've been watching the Evergrande property issues. We've been watching their energy crisis that's going on right now. They have a coal sourcing issue, both with Australia, self-inflicted wound there, also with Indonesia. They ut off coal exports to China just a couple of days ago. They're worried about their own supply. There's an energy crisis worldwide if folks haven't been paying attention. But we think most of that pessimism is already priced in. So the bad news is already kind of in the stocks. We have a beautiful supply picture for 22 and 23. So if demand is simply baseline, we're going to do good. If demand exceeds our expectations, some of these stocks could be multi-baggers. So that's dry bulk. That's a speculative position, if that makes sense. We don't know what's going to happen, but we believe it could happen in our favor. And the third sector I want to talk about is tankers, and then we can do follow-ups or whatever.
Sure.
But tankers are a recovery play. Tankers totally bombed out during mid to late 2020 and also all last year. The reason why is because tankers depend on the volume of oil transported globally. And so you had a demand slowdown, big time, stop because of COVID. And then at the same time, you had a supply cut because OPEC, cut their exports. So you have less demand pull, you have less supply push, you need less tankers, rates go to basically zero. So it's been a bad environment for the tanker markets. We think there's going to be a lot of recovery in the demand side. The last part, the only part that hasn't recovered is jet fuel. Diesel volumes are back to normal, gasoline volumes normal, industrial production levels, power consumption levels, everything's back to normal except for jet fuel. That's the only laggard. We're at like 35, 40%, 45%, depends on what country you look at on a global basis. Omicron really pushed that back by a few more months. But I'm hopeful that by mid to late 2022, that jet fuel demand will get closer to those 2019 peaks, 2019 high levels. And if that happens, that's going to be the last final juice we need to get that demand picture right-sized. OPEC's already came up with a plan. They're going to boost exports by 400,000 barrels per month. Based on that plan, that trajectory, if they stick to it, then mid to late 2022, we should see a strong tanker market. So we're being very selective with tankers. It's deep value. It's bottomed out. All the companies are losing money as we speak. But we think that could be a recovery play in the next, I would say, 7, 8, 9 months.
Got it. So yes, follow-ups on both of those sectors because they're interesting. The dry bulk, first of all, you talked about the supply picture. We're still talking about the supply of ships or the supply of the actual raw goods that are the dry goods that are being shipped?
So for dry bulk, I'm speaking specifically to the supply of new ships hitting the water. For oil, but for tankers, I'm talking both. I'm talking both about there's not a lot of tankers hitting the water, but there's also, we have to look at the supply of oil out of the OPEC exporting countries.
Right. And I believe OPEC they were meeting today as we speak. I saw a headline that they were sticking with their plan. I don't know if that was finalized, but
I haven't seen today's update yet. We're recording early in the morning here, but the last thing I'd heard a couple of days ago, the rumor was that they were sticking with it. They stuck with it in December when Omicron was even more of an unknown. So I would be surprised if they changed tack. But of course, we got to look at the news, right? So if the news changes, if they decide to cut that, that would be negative. That would be bad for tankers, obviously, if they did decide to cut their rate of exports.
And jet fuel as a demand there, you were talking about, is that strictly travel? Is that strictly air travel? Or is there another component to that investors need to watch for as they're trying to see if your demand thesis is going to play out?
The easiest thing to look at and track, and we don't really have a huge edge on that because anybody can track this data, is just the global air traffic volumes, both in terms of airplanes and in terms of people. And there's great websites out there that track that sort of stuff. The TSA has a great website that says how many passengers went through security checkpoints and things like that. And US domestic travel, even into this Christmas season with Omicron surging, notched a pretty strong recovery. It wasn't as strong as 2019, but if you look at the air traffic volumes, I mean, we're at 85% or so back. So it's not so much the domestic US air travel, it's more so global travel. So think of business people flying from, LA to Shanghai, or people flying from New York City to London, and intra-Europe travel and Europe to Asia travel, things like that. It's really the global side of the air traffic that hasn't came back yet.
Yeah, there's definitely a lot of friction still. As somebody who invests in a lot of travel stocks and also somebody who likes to travel, theoretically, there's still a lot of friction. There's still a lot of, you have to have a booster to get in here. You have to test. You have to, obviously, as we're speaking the last week and a half, headlines about airlines canceling thousands of flights a day in the States. And so, yeah, that totally makes sense. So maybe a last question on the sector, any names that you'd like to talk about that are standouts in either, you've already covered containers pretty well, but dry bulk or tankers, anything that is really interesting to you?
Yeah. So, of course, we have our own model portfolios and stocks we've picked and selected and all that sort of stuff. So I won't divulge the entire model portfolio to be fair to our members and stuff. But one company I will mention, it's one we mentioned recently publicly, is International Seaways, INSW. And that's a US listed, US headquartered, the CEO and CFO are both US citizens as well, crude and product tanker company. So they not only do the crude oil, from OPEC to the US or from US to Asia, they also do the products, the jet fuel, the diesel, gasoline, that sort of stuff. So they got their hands in everything. They have almost 100 tankers in their fleet. They have an active repurchase program. They trade at around 60% of their net asset value. Net asset value is if you took the ships, you sold them today at the current market values, and those market values, we have them updated as of today, as of January 4th, 2022. It's about $26 a share is their net asset value. They trade around $15.50 last time I checked. There's about 60% of net asset value. They have an active repurchase, which is kind of like an arbitrage if you think about it, because they're buying those shares at a discount to their net asset value. And they have a huge liquidity catalyst coming in mid-2022. They have this joint venture that has long-term 10-year oil field servicing contracts in the Middle East. And those contracts are renewed until 2032. So they have a decade of contract. The debt on that joint venture will be fully paid by mid this year. So what that means is they have a 10-year contract, very high free cash flow, debt free. So they can either sell that joint venture. They haven't decided what they're going to do yet. They can either sell that joint venture to somebody else, or they can just refinance it again. And if they refinance it again, they can take a loan against that 10 years of free cash flow and pay the company a dividend. And so we think there's going to be between 100 and 150 million in free cash flow unlocked by the middle of 2022. So again, tanker market recovery play, US listed, US headquartered, excellent corporate governance, active repurchase, 60% net asset value, and a liquidity catalyst. So hopefully I've talked my book strong enough on that one. But no, that's the one company in tankers where we're all in on that one. Some of the other tanker companies, we're not quite there yet.
You mentioned earlier that the tankers are losing money. How does you pointed out the liquidity, but in terms of balance sheet and cash burn for INSW right now, how is that what's that outlook right now?
Yeah, it's a great question. The best question you should be asking. Quarter three was basically cash neutral. We think quarter four is going to be similar. They're going to report that probably in about 3 or 4 weeks. We think quarter four is going to be close to cash neutral. They've also divested about 15 older ships. So they've taken their older tonnage, less efficient tonnage, but they've taken advantage of the fact that steel prices are higher, right? Commodity prices are higher. So they've actually been able to sell those old rusty ships at a much higher price than we thought they would have been able to do. They've taken those ships, they've taken about half of the proceeds, paid back the debt that was associated with the ships, and used the other half of the cash to bolster their balance sheet. So we don't foresee any sort of liquidity issues. We don't see any sort of balance sheet issues. Their overall debt to assets is pretty healthy. It's around 35 to 40% debt to assets. So nobody, I mean, you asked the best question. What's the cash burn look like? What's the balance sheet look like? And that's why with INSW, I'm so comfortable saying, look, we're in. I don't say like not all in, like it's not 100% of my account, but in terms of as much as I can be into this company, like we're into it. And because we're not really worried, if the rates don't quite recover yet, they're going to be okay. There's a couple other tanker companies, I won't mention the stock symbols, but some popular tanker companies where if the rates don't recover by, middle 22 or late 22, there could be dilutive equity offerings. There could be some financial difficulties coming up.
Yeah, I have some memories of the tanker companies. There are some interesting characters out there and some interesting stories there.
Certainly. So those are trading stocks, but INSW is an investment for us.
Got it. Yeah. Well, and it's also funny that used cars has been such a theme of the last year. It's nice that used ships also can well play it.
Used ships. Yep.
Another inflation cause. Just on Value Investor's Edge, what's anything new going on there? You've been running it now this is your 7th, 8th year that you've got going?
This will be the 7th in terms of calendar years. Yeah, we launched in mid 2015. So this will be the 7th calendar year. It's scary. I'm starting to age myself out or something. But no, it's been enjoyable. Look, our membership is as large as it's been. We have a great team. We have a team of 5 now. So we've really grown a lot. I know you and I have known each other for a while. We spoke, but we have a macro guy, James Catlin. I think you're familiar with his work. We work with a guy in energy. His name's Michael Boyd. We brought on a full-time associate analyst. His name's Clement Mullins. He does fantastic work for us. We have a full-time tech guy who builds out our analytics platform and updates our models. So yeah, it's really came a long ways from where it was maybe in 2015 or 2016 when we first launched. But yeah, we have free trials open. I don't know when this is going to be posted exactly, but we have free trials open through January 10th. So the first week of the year, basically. And folks can go to Mintzmyer.com. That's a fun one to spell, but MINTZMYER.com. You can try one of the free trials. They're 2 weeks available, no obligation. And you can kind of see what we offer and see what our models look like and see how the things work and, make up your own decision. It's not for everybody. The price point is a little bit higher, based on the research we provide. But yeah, thanks for asking, Daniel, and giving me a chance to pitch the platform a little bit.
As somebody who was on that side of the fence before and have worked with you on it, wouldn't have missed that chance. We'll make sure we would have run a title with the website at the beginning of this video. We'll also put links where appropriate. All right, Jay, anything else for the year ahead? Anything else you want to make sure you cover or make sure that people are thinking about with respect to shipping or the markets as a whole?
Yeah, absolutely. I would just like to close on kind of the same theme as we started. Look, we did 136% in 2021. I don't expect that again in 22. Those are crazy returns. Might never see those again. Anytime we get too cocky or overconfident, that's when too many risks are taken. So now is the time I would be dialing back the leverage, dialing back the margin, not using any sort of those aggressive products. I think the risk reward is the best we've ever seen. But that doesn't mean the ultimate return is going to be the best we've ever seen. So be prudent out there, be careful, don't over allocate to a sector and just, keep a level head on your shoulders. And I think 2022 is going to be good for us.
All right, great stuff. So I think we talked about ZIM, DAC, TGH, and INSW, which are long all 4 of those stocks. That's correct.
That's right. Yeah, I think those are the only 4 names we mentioned specifically. I'm long a plethora of shipping names, but those 4, yes, I am currently long those as of January 4th, 2022. I don't know, if you're looking at this video in a month or, those positions may change, but as of right now, I'm long those names and no changes planned right now.
Right. Okay. Well, Jay, best of luck to you, wishing you prosperity and health in your portfolio and beyond. And thanks for always fun to talk with you about the markets and about shipping.
Fantastic. Thanks for hosting me, Daniel.